Okay, well, let's move on to my next guest because we're going to talk small businesses and the impact this current environment is having on them. Anthony Landahl from Equilibria Finance joins me now. Anthony, great to see you there. Of course, on this Thursday, as we often chat, sometimes, very often, about the housing market and mortgage finance, but today, small business finance. Really, really interesting. Wanted to ask, how have interest rates been impacting small business? We talk about the transmission mechanism through households and how that affects them. Not so much business. What's it doing?
Yeah, g'day. Great to be here again. And look, I think we have to look at small business as a very resilient part of our economy. It makes up some 55% of our economy, and small business has been coming off a pretty strong background over the last 12 months. In fact, lending's been up about 6% year on year for the last 12 months, which has been on the back of low costs of borrowing costs with the lower interest rates. There's been a lot of M&A activity. People are eating into their working capital requirements and investing in growth. But we are facing some headwinds now with these increasing rates. Obviously, the increasing rates are increasing costs of borrowings. We've also got the inflationary pressures coming through, which we're now seeing some costs up around 14.5% is the average price that SMEs are putting up. 33% of SMEs haven't passed on any of those inflationary costs. There's very difficult labour conditions, finding staff, retaining staff at the moment, and there's also economic uncertainty. So while small businesses are resilient, market sentiment is down a little bit on the back of a number of factors, including increasing interest rates, increasing the cost of borrowing, and making some small businesses rethink access to funds and to rethink those investments.
Yeah, okay. So we have a pretty good sense that consumer, I should say, sentiment is reasonably poor, and we know the reasons why. I think we're all experiencing them in some way or another. Business sentiment, though, has been very, very resilient, at least relatively speaking. Maybe from your anecdotal point of view, how is sentiment out there right now? Because certainly the data suggests that things are, at least in this very moment, okay.
Yeah, and the data does reflect that. Business sentiment is strong. Businesses are resilient. I think we might see over the next 12 months will be an interesting time frame. I mean, as I said, the last 12 months we've had 6% increase on credit growth to SMEs, which reflects the investment they're putting into their business. We're now coming off the back of low rates, but SME sentiment is generally pretty strong, but it's going to be interesting to see the data over the next 3 to 6 to 12 months with some uncertainty around economic conditions, rising cost of borrowings, difficulties in the labour market in terms of very low unemployment, retaining staff, and those types of things. We've also had some supply chain issues, and there's the recent issue around some of the tugboat strikes that might potentially hamper some of the activity leading into the end of the year. So SME sentiment has been strong, but it's going to be interesting to see how the next 3 to 6 months play out. A lot of the finance we're seeing around small business, they might be consolidating debts, they might be restructuring debts and cash flow debts that they might have had through COVID, paying out some tax debt they may have retained. So there's been quite a lot of restructuring of existing debt and existing terms, as well as investment in businesses. That's the type of credit activity we've been seeing.
Okay. So if you were to sort of get a sense of where 2023 may go, is business conditions still looking reasonably ample? And I mean, are businesses all that worried about rising interest rates? Again, because it tends to affect businesses a little differently, compared to a household, especially considering not all businesses are, as highly leveraged as how consumers are or households are to the housing market.
Yeah, small businesses tend to approach accessing debt a little bit differently. A lot of them use debt to grow their business, to invest in their business. And we've seen really strong investment in small businesses, particularly in construction, particularly in professional services, particularly in project type work. So there's been a lot of investment in businesses and in their growth. A lot of businesses use debt to fund their growth. A lot of small business owners move away from the banks. There's been a big increase in non-bank type lending to small businesses where They may not have to bring personal assets into it. So small businesses looking at alternative sources of funding through trade credit to grow their business, through their receivables terms to bring in the cash flow to reinvest. So businesses are very much on the lookout for investing and investing in their growth in their business. And they often see the interest rate may have less significant impact. It might be more about the type of facility they're looking at, their terms of trade, their working capital facility. So the interest rate may not be as significant as a homeowner because it might be more about the type of facility they need to fund their growth.
Can I ask a question a little bit more about just, I suppose, the industry more broadly speaking? I've said this a couple of times in the show and proud to do it as well. Father, small business man, has been for 25 years, and every so often, especially when things start to get a little bit tight in the economic cycle, there'll be complaints about the availability of credit from accessible at a bank perhaps, and alternatives need to be sought. Sometimes those alternatives aren't there. There's arguments that maybe it's not a robust enough competition in Australia to really compete with the banks. What's the industry like at the moment? Do you see businesses trying to find alternative sources of finance, more competitive I suppose, providers? What are the dynamics?
Yeah, that's a really good question. One of the biggest challenges for small businesses is access to credit, and access to credit through banks. Banks often might try and tie up a personal asset into business lending. They might have a much more a difficult path to access funds through banks. There's a lot of non-bank lenders coming in. There's a lot of alternate funding sources for small businesses now, whether it's securing it against an asset, whether it's securing it against a receivables book, whether it's trade finance, whether it's actually securing it against a commercial asset to leave personal assets out of it. And there's also a lot of non-bank lenders now who have a different appetite for risk, who are focusing on small businesses and investing in their future and their growth. In fact, 33% of small business funding now is through non-bank funders, which is quite a large amount, and that's grown rapidly over the last 2, 3 to 4 years. So, yeah, one of the biggest issues for small businesses, particularly when they might be facing some of the headwinds in front of us with the rising costs of borrowing and the inflationary pressures we've talked about, is access to credit. And that's where a lot of these, I guess, non-bank funders or funders who might have alternate options to what some of the banks might provide are growing, and they're growing up to a third of the market share now, which is good for small business. It offers competition, choice, and it often offers a solution that they wouldn't be able to get through a bank.
Yeah, absolutely. Interesting stuff. One more question. Can't let you go without just maybe putting this as the cherry on the cake. Just a bit of an update on what you're seeing in terms of housing finance, the housing market generally at the moment. Just a quick health check.
Yeah, quick health check. Look, what we're seeing is the rate of decline in the market decreasing. So that's a good thing. We obviously have had the housing market come off record highs. Nationally, it's come down around about 6%. So we're still well above pre-COVID conditions. The spring selling season this year has been a lot slower. It's down around 15% on the last 12 months ago, but it's still 5% above pre-COVID average, which is an interesting bit of data that we've seen recently. Look, access to credit is still there. People are still borrowing, but the amount they can borrow is less, but the market has cooled off. I think 2023, we're going to see investors come back into the market. They've built up some cash reserves. They've got some equity, and I think they're going to find some opportunities in 2023. I think owner-occupiers, they may be waiting for the market to cool a little bit more, but there's plenty of opportunities. There's a lot more, I guess, balance in the market between buyers and sellers, whereas last year was very much a seller's market with prices running away from a lot of buyers.